How gold and precious metals elevate your investment game to new heights of prosperity. In the world of finance and investments, the allure of gold and precious metals has transcended centuries. But today, we're not just talking about shiny objects. We're talking about the role of gold and precious metals in your investment portfolio. In this detailed and engaging video, we'll explore 3 compelling reasons why you should consider including these assets in your financial strategy. So, without further ado, let's get started. Strategic asset allocation. Let's start with strategic asset allocation. It's a method used to achieve a diversified investment portfolio by appropriately balancing asset classes with different correlations, aiming to maximize returns while minimizing risk. Surprisingly, many portfolios lack diversity, primarily consisting of stocks, bonds, and cash. Real estate, commodities, precious metals, and collectibles often find no place in these portfolios, leaving them inadequately diversified. A study conducted by Ibbotson Associates titled Portfolio Diversification with Gold, Silver, and Platinum found that traditional portfolios comprised mainly of stocks and bonds lack the negative correlation necessary for full diversification. Precious metals, on the other hand, have consistently shown the most negative correlation to other asset classes, making them a vital inclusion for diversification. The study, spanning from 1972 to 2004, revealed that by allocating just 7 to 15% of a portfolio to precious metals, returns increased while risk decreased. This isn't contingent on a bullish precious metals market or a bearish financial market. It's based on historical data. Precious metals, even during the bear market of 1980 to 2002, outperformed cash and inflation. In periods of high inflation, like from 1973 to 1984, precious metals emerged as the top-performing asset class. The study underscores that precious metals serve as a potent hedge against inflation and the cornerstone of diversification due to their negative average correlation with other assets. Hedging. Hedging is another crucial role for precious metals in your portfolio. They act as a shield against various investment risks. Currency exchange risk is one such threat, as currency crises have occurred regularly since the abandonment of the gold standard in 1971. A prime example of this is the 1920s Weimar Republic of Germany, where the gold price skyrocketed during a currency crisis. Similar events occurred in Mexico in 1995, Indonesia in 1997, Russia in 1998, and Argentina in 2002. When confidence in a currency diminishes, people turn to precious metals for safety. The current situation of the US dollar, the world's reserve currency, is raising concerns. A burgeoning money supply and unsustainable debt levels could lead to hyperinflation and currency collapse. Gold's rising price signals growing distrust in a government's monetary policy, making it a hedge against currency devaluation. Additionally, precious metals protect against the steady erosion of purchasing power caused by an expanding money supply. Since 1970, both the Canadian and US dollars have lost about 83% of their purchasing power. Preserving purchasing power. To illustrate how precious metals preserve purchasing power against inflation, consider this. In 1971, a compact Chrysler cost about $2,300. Today, it's $14,000. A starter home was $24,000. Today, it's $236,000. The Dow Jones was at 890 in 1971. By the end of 2005, it stood at 10,500. In contrast, gold, priced at $35 per ounce in 1971, surged to $513 by year-end 2005. When converting these prices to ounces of gold, you'll notice a decline. In 1971, the car cost 66 ounces of gold. Now, it's just 30 ounces. Similarly, the house cost 703 ounces of gold, but now it's 431. Even investing in equities costs less in gold terms today, with the Dow Jones requiring only 20 ounces compared to 25 in 1971. The third aspect of hedging with precious metals is protection against sudden, unexpected financial crises, commonly referred to as fat tail events. These include wars, terrorism, natural disasters, health pandemics, and systemic financial risks. During such events, traditional financial assets often suffer, while precious metals tend to rise dramatically. Tactical asset allocation. Tactical asset allocation is all about actively adapting your investment portfolio to capitalize on evolving market conditions. In the current economic landscape, marked by surging oil prices and mounting inflationary pressures, precious metals are positioned to outperform traditional financial assets. The bull market in precious metals commenced back in 2002 and entered its second phase around 2005. This shift indicates a broader, more enduring trend beyond merely responding to the US dollar's decline. To guide us in this endeavor, we look to the Dow to gold ratio, a pivotal indicator. In 1999, this ratio peaked at over 40 before sliding to its current level of around 20. When this ratio is on a downtrend, as it is now, it signals the need to overweight precious metals in your portfolio to maximize potential returns. U.S. economic vulnerabilities. Understanding the vulnerabilities in the U.S. economy further reinforces the case for precious metals. The U.S. dollar's health profoundly impacts global economies and investments. With the U.S. economy heavily laden with debt, ballooning trade deficits, and outsourced manufacturing, it faces potential currency crises. The U.S. current account deficit is nearing 7% of GDP, a level historically associated with currency crises. When these crises occur, demand for alternative currencies, including precious metals, surges. The U.S. debt-to-GDP ratio has exceeded previous highs, and foreign entities hold a significant portion of U.S. government debt. If foreign investors lose confidence in the dollar, a massive shift toward precious metals is expected. The relationship between gold and oil is another crucial factor. As oil production declines and demand rises, oil prices are set to surge. Historically, precious metals, particularly gold, have shown a positive correlation with oil prices. This means that precious metals prices are likely to rise along with oil. Bullion versus mining stocks and bullion investments. When incorporating precious metals into your portfolio, it's essential to consider whether you should invest in bullion or mining company stocks. Bullion, in the form of physical gold, silver, or platinum, offers unique advantages in your investment portfolio. It serves as a reliable hedge and tactical asset allocation strategy, especially during times of economic uncertainty and currency crises. Unlike other assets, bullion cannot decline to zero in value, making it a resilient choice. Mining company stocks, while potentially lucrative during bull markets, come with different risk dynamics. They are exposed to operational challenges and market fluctuations. During events like the 1987 stock market crash, mining stocks suffered greater declines than equities in general, while gold prices increased. When considering bullion investments, it's essential to ensure they are fully allocated, segregated, and insured. Avoid investment vehicles that merely promise future delivery, as they introduce counterparty risk. Precious metals investments should precisely track the market prices of bullion and remain independent of equity markets. Allocating 7 to 15% of your portfolio to precious metals is justified for strategic and hedging purposes alone. Yet, given the vulnerabilities in the global financial system and the looming peak oil scenario, a higher allocation is advisable. The current market trends confirm the need to overweight precious metals in your portfolio. Whether you see this as an insurance policy, a strategic diversification tool, or a tactical investment, the role of gold and precious metals in your investment portfolio is undeniable. If you found this video informative, please like and share it. And don't forget to subscribe to our channel for more engaging content on finance and investments. Thanks for watching, and we will see you in our next video.